This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're going to dig deep into parts of the corporate lending world with a seasoned pro, Todd Trabucco, CFA of ITE Management. Some of you will remember Todd from his speech at one of CFA New York's asset owner events last year. At that point, his name tag read Cambridge Associates. So his view as a former asset owner at this volatile time is also valuable in my opinion. Prior to Cambridge, he was at Kayne Anderson and Moody's, and Todd has advised both the U.S. Treasury and the Inter-American Development Bank. So Todd, thank you for being here.
My pleasure, Rob. Thanks for having me.
So if you don't mind, if we could start with your view of the macroeconomic scene first, how it pertains to this sector. I saw you write on LinkedIn about a slightly unconventional view of the market amid COVID-19, in that it was positive or had the potential to be positive. So could you say how you think it might go?
Well, look. I think that, and I'm not a macroeconomist, although I play one on TV. I, I think that in this particular instance, what's different this time around is the signaling of the aggregate demand decline, and so historically, when you have recessions, you see profit erosion, you see continued kind of reinvestment, the destruction of capital, and the misallocation of resources, or generally the overallocation into one sector, whether it be housing in 2008 in the US and the early 90s and late 80s, or or tech and telecom in 2001. You don't really see that here, maybe in corporate credit a little bit, but you generally don't see that overallocation to certain sectors. This is a decline in aggregate demand that's been mandated by the government. Mm-hmm. And that makes this a little bit different because I think the recovery might be faster as well. That's number one. So I think that if you just think about it, right, if Dr. Anthony Fauci comes out and says the curve is flat and the president says it's a go ahead and go about your business, demand should come back for the most part. There are certain individuals that will be permanently impaired, unfortunately, in certain businesses as well. Mm-hmm. But I do think the positive is that to the extent that there was binging in the corporate world and there were zombie companies floating around, this will purge them out. This will purge them, I think.
Yes, and that could be healthy. And would you say that the borrowing by many corporations over the last couple of years is probably positive for them in general because of the relatively cheap interest rates they got that borrowing at?
Yeah, people give the airlines a lot of stick for their share buybacks, and for borrowing a lot generally for the corporate sector, not just the airlines. And it just seems to me a bit of a rational response. Mm-hmm. If capital is that much cheaper in the credit markets, then it would just seem to me as a controller, CFO, treasurer, that you would want to take on as much of that cheap capital as possible within prudence, right? Within prudent limitations. But that's the incentive that we create when we make money cheap. We create the incentive to go out and use it.
Right, and borrow, yeah. Now, you mentioned that there would be some who would be affected. Do you see, despite quick rebound, if there is one, if there's a green light that comes on and we all go flying off the line, do you think that is a different sectors, or did you mean people in the consumer side?
Look, I think that there are. I'll do both of those. I think the first. I think there are on the consumer side. There are individuals that will have a hard time coming back and recuperating. That's unfortunate. But I do believe that there was a lot of marginal hiring taking place prior to this. For example, I was talking to a hedge fund manager 2 years ago in Hong Kong, and he went out to Houston and he talked to some of the drillers, and he said that they had increased the starting salary for a roughneck by 50%. Okay, and they had waived all drug tests.
Okay.
So, and that's not to say that roughnecks don't deserve a 50% salary increase. It's not to say that you can still fail a drug test and yet be a good employee. That's not what I'm saying. What I'm saying is that the bar was adjusted downward, to increase supply, right? And some of those people, those standards might come back after this. Right. And the people who would not have cleared that bar won't clear it again, right? So I think there's going to be people that are going to be permanently hurt, which is very unfortunate. But I think that that's a definite possibility.
Yeah, I mean, without getting into too much of the accounting over households, I presume you mean people who lost their hourly jobs because many of those people have a high proportion of fixed expenses
Yes.
that don't really give them much flexibility.
Yes. I think that that's absolutely right. There are also going to be salaried employees that are going to be losing their jobs and will perhaps find it more difficult. I think there's going to be some tragic stories, but I think as a workforce, I don't see this as similar or equivalent to the Great Depression, where the economy was shedding jobs organically.
Mhm.
This is essentially a mandated unemployment by the government.
Right, it's a switch that could be switched back. Yeah. So, are there other sectors you'd like to talk about beyond drillers and airlines?
Yeah, look, I think that the auto supply chain is critical to this country. It employs, I think, 1 million people. That's a
Mhm.
lot, and I think that needs to come back. And I suspect it will at some point. But right now on the retail end, you're seeing dealers struggle. I don't even know how that's shaking out to the rest of the supply chain, but I imagine it's pretty tragic. Um,
Mhm.
the well, the leisure sector, obviously, restaurants, and primarily, but also, bars, things like that. That's, that's going to suffer, but that should come back. I do think that the silver lining in all of this, whether it's rooted in altruism or not, is that people will be more willing to share the pain,
Mhm. Yep.
if only because you can't be aggressive. So, for example, um, if I lose my job because of this, and I can't pay my mortgage, what good does it serve the mortgage lender to foreclose? They won't be able to sell my house under these circumstances, probably.
Right.
If I'm a tenant, the same thing, right? Who's going to come in and step into my lease? I think that there's a lot of shared pain and a lot of I see it already in talking to colleagues in the market. There's a willingness to share that pain.
And so you were I saw that you were advocating and saying that there would probably be extensions to share that pain also, I presume.
Yeah. So the banks look. I think that's where you're going with this. I think there's a couple things that are driving that will drive an amend and extend kind of wave. The first is it just makes sense. It just makes sense that if you had a thriving business that all of a sudden got its revenues turned off or put to zero through some externality and government decree, that it makes sense to stick with them. Also, you have, you know, you probably will have lent to a business sponsored by a private equity group, and so you want to maintain that relationship, right? And finally, if your whole portfolio is in the tank, whether you're a bank or a direct lender, you probably just simply don't have the workout resources to tackle it all at once.
Right.
And finally, all of these businesses can't file for bankruptcy. You would overwhelm the courts. There aren't enough restructuring advisors and attorneys probably to deal with the workload. So I think that there are a lot of natural breaks that will kind of dampen and temper the aggressive nature of lenders.
Yeah, I was actually speaking with an investor in commercial real estate about that the other day. He was saying that the courts are all shut down now anyway, so when they come back online, it's not going to come back like a shot either. Well,
Rob, I tell you, it's crazy. This happened in '08, Rob. I mean, there was a whole line of borrowers that were lining up to file bankruptcy, but there was insufficient DIP financing capital to
Mhm.
service them. So it's these little mechanical kind of snafus that can sometimes redound to the benefit of borrowers.
Right, right. Well, maybe we could shift a little bit to an area that is maybe not quite so macro and talk about a good debate that began a couple of years ago around the increase in the proportion of Cov Light loans. Now, you had done some interesting work, and I can post that paper in the show notes for anyone who's listening to this that you wrote at Cambridge. Could you just give us the top line of the Cov Light trend?
The Coverlight trend, well, as we all know, I mean, Coverlight now accounts for, I don't know what the statistic is this month, but north of, I think, 88%, close to 90% of all new issuance.
Yes, and in some months it was 100. So,
Yeah. So, look, I mean, that basically turned the broadly syndicated loan market into the floating rate loan market.
right.
So, and so thinking about that, what does that mean in this current environment? And I think it just means that, the the rights that accrue to a lender under normal circumstances just simply aren't there.
Mhm.
And so how do you handle that? How does one be proactive? And I think we'll see differences between the more decentralized markets of CLOs and the broadly syndicated market. We have a lot of different holders, loan funds, et cetera. And the centralized markets, which is the shadow banking sector. I think that the outcomes there will be somewhat different. I think the responses will be different.
Well, this one former rating agency person, myself speaking to another one, our firms have gone a long way to downgrading some of those things already. So, what is your take on how, say, CLOs? Because now after the Great Recession, we all look to structured first. How do you think CLOs might swing with this?
I happen to believe that CLOs, under normal circumstances, and as proven out by the last cycle, have been very resilient. I did a lot of work with this with my former colleague Shane Levy, who used to work at Cambridge with me and recently joined the Amherst Endowment. Bright guy, and we did a lot of work on this. And I think we found that out of all the CLO tranches, according to Moody's, only 72 of all the tranches, right? Only 72 are actually impaired coming out of the crisis.
Okay.
And that was as of the writing of that report. The jury was still out there, right? So, and that report was, I think, published in, I don't have it on me, but I can look it up. It was recent. I think it might have been like 17 or 18.
Okay.
So I think the wild card there obviously is the Covey Light nature of it. So I think the challenge is if you start seeing defaults and you start seeing a lot of these instruments sort of hit the triple C and D buckets. I don't know how quickly our former employers will move on that. But then you could see some real puking out of these assets into the markets.
Right. And I wondered also if you think the explosion of the founding of CLOs over the last couple of years matters too, because of course, when you have a lot of new founders, you have some lower and lower quality in the portfolio portion of it.
So when I was at CA, there would always be, CLO managers would always say to us, well, we don't have to buy the market. We can be choosy. And I suppose that's right. If you have enough scale, if you have great relationships. But I think to your point, if you're starting out, you have less latitude to be selective.
Yeah. I mean, some people who did this that spun out of a larger one, they probably have those things. But the other ones who came out of something else, I just don't know. Well, thank you, Todd. This has been really interesting. Take a look at the one of the parts of the plumbing of the market, if you will, and I appreciate it.
Yeah, my pleasure, and thanks to the CFA Institute and CFA New York for all of its wonderful work. I'm looking forward. There's supposed to be an event April 30th. That got postponed. My good friend Stephen Connolly was organizing some of it, and so I hope to see everyone when it's rescheduled.
Oh yeah, I hope we will have a good date for that pretty soon. So thank you all for listening in to Compound Insights by CFA Society New York. You can find other episodes on the podcast app of your choice and on our website, cfany.org.